All right, there's two things that we have to talk about in this video. One being Google does not have to sell its Google Chrome browser or its Android operating system. And then number two is Lyft. So Lyft wants to raise $450 million in exchange for convertible notes. Now, I had a couple people ask, am I going to get diluted as a Lyft shareholder? And we're going to get into that. Now, I know I'm late on the Google Chrome news, but hear me out. I don't do content creation completely full time yet. I hope to do it one day, but I still got to talk about it because it still is a really big thing in the industry. So before we get into it, I ask one thing is just to give this video a like. It helps push the video out and help people see this video. So getting into Google, after that news that was announced that they don't have to, divest any of their businesses, stock popped what, 9%, almost 10%. Really, really sharp movement. If you're a Google shareholder since like that dip in 140, if you bought Google when it was like in the 140s, huge buying opportunity right there, right? I mean, just looking at this weekly chart, this is like a V-shaped recovery. Huge opportunity. I personally wasn't buying. If you followed me through since 2022 and 2023, you know I was buying Google all the way in the 90s, and we sold out, I think, in like 150, 145 or something like that. But the ruling is Google doesn't have to sell Chrome or its Android operating system. Now, there's one main thing that some people need to take away from this, but for the most part, Google didn't really lose much here. So this is a massive boost for Google. But the main thing is, right, so we can see right here, Google will not be forced to sell the browser, ruling it after they ruled it a monopoly. So what this kind of means and just the other things that we kind of got out of this. So there's a few other things. What Google does, if you don't know, so if you have an iPhone and you go on their, Safari web browser or whatever it is, right? And you look something up, you go to, Google is like the default search engine on the phone. So what Google does is they pay Apple, I think it's like $20 billion a year, to only let Google be like the default browser on their hardware, right? And what they were doing before was, hey, like we're going to pay you $20 billion to have our platform on your hardware, but you cannot go through to any other competitors. It's exclusive to only us and us only. And that is one of the rulings that the judge actually made to prevent Google from doing going forward. Was Google is still allowed to pay companies. So they could go to, I don't know, they can go to Meta, for example. And let's just say they wanted to pay Meta $10 billion a year. If they went to Meta and said, hey, we want Gemini, our AI LLM model, to be the default LLM on your Oculus Quest hardware, they can do that. But what they can't do now is say, yeah, we're going to pay you the 10 billion, but you cannot go to any other competitors, nothing. It's exclusive to us. So that's a pretty big deal. Not as big. If the judge ruled that they can't pay anybody, then that would be like a bigger deal, but they still can. The only thing that Google really lost is that they have to, I can see if I could find it in here. They have to basically give up some privacy data to competitors. So it's not really a big deal. They really didn't lose much in this. And that's why the stock is going up. And same thing for Apple, because Apple can still receive $20 billion a year. And that's a massive amount of money for them to just allow Google to be on their hardware. So I think it might have been in this one. Yeah, but must share data and big antitrust ruling. Yeah, I can't find it. There was another thing in here, but that is basically the big thing right here. So massive win for Google. And then the judge hit on one thing and why he didn't really break them up and have them sell their browser. So he touched up on like artificial intelligence, applications like or companies like OpenAI, Perplexity. He said that the rising competition of those models and companies are the reason why they actually might disrupt Google Google search. And looking at that from like the tech industry perspective, I mean, it makes a lot of sense, right? And you're going to see a lot of companies really come into play and try to make some noise in this industry. Whether it's Perplexity, right? Perplexity, their search engine, or I should say their model is really good. I've been using it over the past year, and they do a really good job. And I wouldn't be surprised if they really start to like come into play and start to take some market share in that aspect. But at the end of the day, Google Chrome is still the leader when it comes to like browser, and then you have Google search. It still dominates, and that's the reason why this is big for Google. And it was funny because when Perplexity put in that deal for $34 billion for Google Chrome, like you kind of just like laughed at it, because Google Chrome is probably worth, I'd say $100 billion just as a standalone business. And that's why Google would have been in trouble if they had to sell that. But they're not. So that is a really big ruling for Google. So if you're a Google shareholder, you're obviously enjoying that ruling. And then I had a question just saying, like, is Google a good buy? Yes, it is a good buy. You're talking about one of the biggest and most efficient company in the entire world. When you're looking at the Mag 7 companies, right? So you have like your Google, Apple, Amazon, Meta, Nvidia, Tesla, right? Looking at these companies, they're great buys. You have some of the smartest people in the world that are running these companies and working for these companies, right? And these are the type of stocks that you just buy and hold and completely just set it and forget it, dollar cost average down if needed, and you just let it ride out for 10, 15 years. These aren't stocks that you want to trade. If you want to get like maybe a 15% swing trade, I mean, go for it. But these are companies that you're not going to get, 100% gains within a year of buying the stock. Now, if you dollar cost average, right? So let's just say, or if you buy on like tariff like dips. So if you bought, at 141, you'd be up 62%, right? But for this to go up another 40%, how long is that going to take? It's not going to happen in 3, 4, 5, 6 months. It's just not. But Google is a great buy long term. You just can't go wrong with any of the Mag 7, especially if you're holding and you have that long term vision. So number 2, I want to move on to Lyft and kind of just get in this. So like I said, somebody asked me, am I going to be diluted as a shareholder? So for now, there's not going to be a massive dilution. There's no reason to kind of, panic that there's going to be more shares, put into the market and it's going to dilute you. And here's why. So what's happening is they're doing these in notes. So there's creditors or investors that decided to give Lyft $450 million, and Lyft is going to give them notes. And what they can do is exchange those notes down the line into shares. But there's a couple things that you have to realize. The conversion price is $23.52. So keep that in mind, $23.52. Meaning the investors, if Lyft is at $22 a share, the investors are not going to convert the notes into shares. That wouldn't make any sense, right? It's $23.52. Why would they convert those notes into shares? They'd be losing money at that point. So that's one thing. Another thing is the conversion price is $23.52. Look where the price is now. That's a bullish sign that the investors think Lyft stock is going to go up, right? So that's always a bullish thing. Now, this is where it kind of gets a little tricky, just kind of with these other call options and things like that. Starting in 2028, Lyft can call back these notes to redeem them as cash as long as the stock is trading 30% above $23.52. That's $30.58. So starting in 2028, right? So if it's 2027 and the stock's higher than $30.58, we're going to get to that and see what the outcome of that would be. But in 2028, they can just redeem those as long as it's in 2028. Now, these notes are good until 2030. So, like I said here, this offsets some of the risk of dilution. Now, another thing that they're doing with this is that they're using some of the money that they're getting to utilize capped call options. Okay. This will protect the stock up to $33.60. Now, regular call options, right? It's basically giving the buyer the right to buy a stock at a certain price. So that price is $23.52. That's what they're buying, right? So the capped option, or I guess the capped portion of this is going to protect them up to $33.60. So this is like an insurance policy against dilution, and we're going to get into that. So with the capped call options, there's three scenarios that can play out. If the stock price is below $23.52, the convertible notes, they're not going to convert, right? It's just debt. And then the call options expire worthless, nothing happens to the stock or the calls. They expire worthless, nobody gets diluted. Now, if the stock price is between $23.52 and that high capped price at $33.60, this is the best case scenario for Lyft, right? So the investors, they're going to probably convert their notes into shares, right? Because if the stock's at, $27, they get the stock at $23.52, they're going to make money, right? They're going to be up on their position already. But this is where the whole capped call options come into play. So the options that Lyft basically bought, those capped call options, it's explained right here. So Lyft can exercise those options, and what they're going to do is take the shares from an institution, right, to cover the shares that they owe the investors, that exchange those notes. That eliminates the dilution, right? Because did not mean to click that. So all they're doing is taking existing shares that are already in circulation, and they're just giving that to the investors that want to exchange them. That's all they're doing. So it caps that risk, right? Now, if the stock price is above $33.60, that's where the cap comes in, and this is where things can get, where you're probably going to get diluted as a shareholder, right? But here's like my point in this is like, if you're buying Lyft right now, I think right now it's at like $17. Let's see really quick. Not even. So it's at $16.75. If you buy at $16.75, now if you've been following me, I've been buying in the $13 range. But if the stock goes up to $33, it doesn't even matter. You're going to be up a decent amount from right now, right? You're basically doubling your money, right? If we go up to $32, $33, I mean, you're up about 100% on your position. You're going to be happy as a shareholder anyway. So it really doesn't matter, even if they dilute you at $33 a share, right? But if you're buying at like the $25 range, maybe $30 range, then that's when things start to get yeah, this kind of sucks. But if you're buying in the $13 range, $14 range, no matter if you get diluted at $33, it doesn't really matter. And then on the bottom here, I was saying that they're going to use some of that money to buy back some stock and potentially use some of that capital to acquire more companies. So that's really big. This is in favor of Lyft. And I don't even know if I said it in the beginning. They don't have to pay interest on these loans. Yeah, so I said it up here. They're not paying interest on it, right? They're just giving them, that's the whole thing of the notes. So again, they're not giving money to creditors, and they're going to be able to put that money right back into the business and do something with it. So really good news for Lyft, in my opinion, especially if they start to acquire, maybe they start to expand more in Europe, or maybe they get into the food delivery business and try to compete with Uber. You never know. But that'll be interesting to see. But that's all I have for this video. I hope you enjoyed it, and make sure to give the video a thumbs up, and I'll see you in the next one.